Hello, Edward Lambert, Effective Demand Research, and this is going to be a video about how inflation might move once the Fed starts raising their Fed rate. Okay, so this is a system dynamics model where you have the inflation rate being impacted by changes in the Fed rate and also changes in the Fisher effect. Now the Fed pulse here is just once the Fed changes their Fed rate, that creates a short-term reaction on the inflation rate. Fisher effect creates a long-run reaction on the inflation rate. And I show a graph in the post that I'm going to include this video where there's a downsloping orange line for the short-run effect, which is the Fed pulse, and then there's this upsloping blue line which shows the Fisher effect. Okay, so let's start out with a projection of where the Fed rate will go. Let's say they project that the Fed rate will go to 2.5%. This is 0.025, which is 2.5%, is what the Fed rate will go to at full employment. Now the Fed says that they will keep the Fed rate abnormally low. Once they get to full employment, 2.5% is abnormally low and is sort of conservative. Some people say maybe 2%, maybe 1.5%. Some people say, well, maybe they'll have to go up to 3%, so we'll just keep it at 2.5%. And we'll say that the natural real rate of growth of the economy is 1% here, which will give us a natural inflation level of 1.5%, which is the difference between the 2.5% and the 1% here. So this red line here shows us the natural inflation level of the Fisher effect as it goes to full employment. So what I've done here is I have shut down the Fisher long-run effect here by giving it a 0 on the attraction. So right now the Fisher effect does not affect the inflation rate. So I just want to isolate the short-run effect, like the downsloping orange line in the graph included in this post. So what I've done here is that you'll see the Fed rate down here to the lower right is on a path. Every quarter the Fed raises it by 0.25%. So over the course of a few years, the Fed rate will go up to 2.5%. See, that's the projected Fed rate here. The Fed rate climbs up to 2.5% right here. So as the Fed rate climbs up, you'll see that the inflation will drop. That's the short-run effect of inflation. Now, at the same time, you'll have the Fisher effect affecting the movement of inflation at the same time. So now I'm going to increase the effect of the Fisher attraction, and you'll see that the inflation will change. I'm going to go up here to about 1. So what we'll see is, as I said before, the inflation will drop once the Fed rate starts rising. There's a pressure to push the inflation rate down. And according to this, it may go down to 1%. So we can see the Fed rate rising here slowly. But then once the Fed rate reaches its goal of, say, 2.5%, inflation stops dropping. And that's when the Fisher effect takes over, and inflation will then rise to its natural equilibrium at 1.5%. And you can see here that once this red line is above, this is the red line is the Fisher effect, and once that's above the effect of the short-run pulse of the Fed rate, inflation starts moving towards its Fisher effect equilibrium. Now you can see that 1.5% is still quite low as far as an inflation target. So the Fed, if considering a 1% and the natural real rate up here, this 1%, the Fed would have to project a higher, say a 3% Fed rate at full employment. If they can project a 3% Fed rate, then the Fisher effect, you'll see that inflation still will fall, but not quite as much as before. It won't go down to 1%. It'll just stay right around 1.5%. As the Fed is raising their Fed rate. And then once they reach their target of, say, around 3% here, then the Fisher effect will just keep taking it all the way back up to 2%. Then the Fed will have somewhat of a normal policy with a 3% Fed rate, and they're on 2% inflation target, but it'll take a long time to get there. This is basically a 6-year path here, starting out with the Fed going up only 0.25%, 25 basis points per quarter. So it's a slow, gradual process to get the Fed rate back up to 3%. Can the economy last that long as far as the business cycle without going into recession? I don't think so. But at least these are the projections looking ahead. Just to recap quickly, that yes, the inflation rate will drop as the Fed rate is going up, but then eventually it will balance out to its long run Fisher effect equilibrium, depending on where the Fed rate is projected to go and what the natural real rate is, these two variables up here.